Right. So we continue with the partnership lesson. And as I was mentioning, last week we looked at the income statement and the appropriation account. We looked at how we calculate the share profits for partners. And we did a question, a full income statement question, where we had to do a complete work question, do things like provision for depreciation, provision for doubtful debts, accruals and prepayments, work out salaries, interest on capital, interest on drawings, do the income statement, and then do the appropriation account. So you guys just had to transfer the figures over into the format. Today's lesson, we're going to look at recording capital in the partnership. We're looking at the preferred method, which is to keep a current account and a capital account for each partner. The current account follows the same rules as the capital account in that increases are on the credit side, because anytime we increase in the capital, we credit that account, and decreases is on the debit side. So if we think about things that would increase a capital account for a partner, right? Share profits, that's increasing his capital in the partnership, just like we would have net profit for the sole trader increasing the capital that they started with. Share profits is that equivalent for the partner. Interest received on capital is another one, and salaries. Things that will decrease his capital would be drawings and interest charged on drawings. So any drawings and any interest charged on those drawings would reduce his capital. So because we have these different things that could either increase or decrease the capital, the preferred method is to keep this separate from the original capital that was contributed to the partnership. So what they have is a capital account where they record the original amount of capital that the partner contributed, and then they have something called a current account, which tracks the changes from year to year to his capital. So they would have a current account balance as the year moves forward, as the years go by. Another benefit of keeping the current account is it helps when we balance that account. It helps determine whether or not the partner is withdrawing too much money out of the business. If he has a debit balance in the current account, and we'll see that just now, right? A debit balance is going to indicate that he's withdrawing more money that he's earning in the partnership, right? And that's an indicator to let them know, well, listen, no, you can't do any more drawings because your drawings is exceeding your capital that you are earning in the partnership, right? With the opposite of this method of using a fixed capital account, and a current account is using a fluctuating capital account. This means you just jumble everything inside of the one capital account. The downside of doing that is that there's no indication to show when this partner is drawing more than they need to out of the business or more than they have in the partnership. And you don't want to do that. Remember, every dollar that is taken out of the business, be it in a sole trader or a partnership, means that is one less dollar available for the business itself to use for investment, for buying supplies, for expansion, for any kind of growth initiative. So you want to curb the amount of money that is withdrawn or drawn out of the business. Yeah. So let's take a look at the slides. Recording capital in a partnership. Now, as I mentioned, there are two ways of recording capital when drawing up the books of a partnership. The first way is the primary or the preferred method that I spoke about, which is keeping a fixed capital account and a current account. Basically, there you have one capital account where you will list the balance or the capital amount that was contributed initially. And then you'll have a current account where you are tracking the fluctuations as the years goes by to capital. The alternative to that is your fluctuating capital account, where everything is just modeled together in one account and there's no separation in terms of the original capital and the fluctuations that happen as the years go by. So with fixed capital accounts, the capital of each partner is recorded as a fixed figure of capital invested in the partnership. Everything else, such as the share profits, the interest on capital, salaries, interest on drawings, and drawings, are recorded in a separate account, which we call the current account. Just like the capital account, it follows the same double entry rules. Excuse me. So to record increases, we credit the current account, and to record decreases, we debit the current account. Just a note, increases will be things like interest on capital, salaries, and shares of profit. So those items are credited to the current account. Decreases would be drawings and interest on drawings, and those are debited to the current account. Right? So when to debit and when to credit in the current account. As I just mentioned, items that increases the partner's current account are written on the credit side, and it represents income earning activities. So they earn income when they get interest on capital, they earn income if they receive a salary, and they earn income when they get a share of profit, right? Debit entries in the current account will be income reducing activities. And income reducing activities would be drawings, when they take money out of the business, interest charged on drawings, and any losses, share of losses. Everybody with me so far? Balancing the current account. Just like all other accounts, you have to balance the current account. After writing in all the debit and credit entries in the current account, you're going to do it just like your other accounts. So add the debit side, add the credit side. The side that is less, or the side you have less on, is where you're going to put your balance carried on figure, right? The difference of both sides. That's where you're going to put your balance carried on figure. That's going to allow you to balance the account. So just to give you a refresher of what I'm talking about. Oops. That's a red bend line there, boy. I'm going to use the line too. Right? If this was the current account, and let's say I have initially I had an opening balance brought down of $100. Apart from that, I just looking at one partner. Let's just put two for the sake of right. Interest on capital, we said, is an income increasing activity. Let's say this guy gets 50, this guy gets 30 for whatever reason. Then we have salaries. This guy get 40, this guy get none. And then let's say we have share profits. Let's say this guy gets 50, and this guy also gets 50. But then on this side, we have drawings. And let's say his drawings here is 300. And his drawings here is 40. And interest on drawings. Let's say this is $5 and this is $50. Right? I'm just making up some figures. To balance this current account, we add up both sides. So we could come in pencil. Right? This side gonna add up to what? 280. This is gonna add up to 240. Here's gonna add up to 350. And here's gonna add up to 45. Now let's look at partner A. Partner A, the smaller side is here, right? Where we have the 45. So my balance carried on is going to be on this side, right? $395, right? I have no balance carried on figure here. Why is that? Because this side is 350, but this side is 280. So I have to put a balance carried on here, right? Because this is the smaller side. So I need 20 to make it to 350. So I need 70 here in total. So only when I do that, if I add up these two sides now, just erase these things. If I add this side up now, then, right, here is going to add up to 240. And I can balance this. Right? Here is going to be 350. Now when I add these up, this is going to be 350. But check what's going to happen here, right? My balance brought down on this side. It's going to be 70. And for partner A, his balance brought down on this side is going to be 395. This is what I'm talking about. So you see how to balance the account one, that's a little refresher on balancing the account. But notice that their balances brought down on different sides. This guy though has a debit balance brought down of $70. And when we look at the total amount of money really that he earned, this total amount of money earned here was $280. But he withdrew $300 and paid interest on drawings $50. This debit balance here of $70 is an indication that he's taking more money out of the business than he's earning. See how important the current account is? Just the side that the balance brought down is on helps us to determine when a partner is, crippling the business, so to speak. They're taking too much out than is coming in, right? So this is how you balance the accounts, and this is how you can identify where a partner is taking more than they ought to or they need to. Right, let's look at an example. Just like the one I did, right? Except we don't have any balance brought down. Here, both partners have credit balances. How can I tell? By this. Their opening balance for their current account in Jan 2001, right, is going to be 8,000 for Taylor, 10,000 for Clark. If we total this side here, 12,500. That's 12,500. This is total borrowings. On this side, his earnings though is 20,500. So he has a difference of $8,000. But his drawings and interest on drawings is less than what he's earning. That's a good sign, a good indication. So to his Clark. Clark is 21,000. But when I check on this side, it is salary and his share of profits. We're already at 28,000 plus another 3,000. That's 31,000. So this is an example of a current account where both partners are in good standing, right? They're not withdrawing more money out of the business than they're earning in the business. And notice that both balances for the current account is on the credit side. So we want to see balances on the credit side, right? We don't want to see them on the debit side. You all okay with that so far? Yeah?
Yes, sir.
All right, nice. Very good. Dan, are you good? Solana, are you good? Right, so what side is the balance carried on? So this is what the point I was trying to make for the last two slides. Sometimes a partner could withdraw more than their earnings. When this happens, it results in a balance brought down on the debit side. And we saw that in our example. So here's another one. Same Taylor and Clark, except that now Clark drawings was 24,000. But remember just a little while ago, right? His total earnings for the period was 20,500. But now that he is drawn 24,000 and paid $1,000 in interest, his debit side is 25,000, whereas his credit side, his earnings is only 20,500. So he now has a debit balance brought down of 4,500. So it suggests that the partner is withdrawing in excess of his earnings in the partnership. It means the partner is taking out amounts greater than their total earnings. Now, this part here, examiners love to ask what the debit balance in the current account means. And if they do, this is what you will see. It suggests the partner is withdrawing in excess of his earnings or her earnings in the partnership. And this means that the partner is taking out amounts greater than their total earnings. Everybody clear on that?
Yes, sir.
Yeah? Okay. Fluctuating capital account. So keeping a fixed capital account plus a current account is the preferred method to the operating with a fluctuating capital account. Why? Because when partners take out greater amounts than their share of profits and what they're entitled to, the current account acts as a warning. It tells us that, listen, this guy is withdrawing more than he's making. The fluctuating capital account, though, does not give us that advantage or offer that benefit. Here's a look. So this is a fluctuating capital account, and I'm using the same balances as we had before. The difference is this figure of bank up here usually would have been done separately in a fixed capital account. But now that it's inside of here and there's no distinction between the capital or current account, all of this is modeled together. So it pads the account. So even though in our last example, he took out this money and his earnings probably wasn't enough, right? This extra $20,000 that we put in there would guarantee that you end up with a positive, with a balance on the credit side, at least as so long as you don't withdraw more than the capital you put in, right? So the balance brought down figures are different. They are much different when we do the fluctuating capital account. Right. So now that we understand the current accounts, we want to take a look at the balance sheet. Now for the balance sheet, nothing really changes to the upper part of the balance sheet. I'm still going to write fixed assets and current assets, subtract current liabilities to get working capital, add the working capital to give total fixed assets to give you your net assets, subtract your long-term liabilities, and that's the whole top part of the balance sheet there in a nutshell. Right? It's the same. The capital area now is a bit different. Now we're going to have to split those columns up to account for the partners. Because, whoops, now we're going to have two partners, Taylor and Clark. You're going to have fixed capital account balances. Then you're going to have current account balances, right? So we're just taking the same current account, list all our positive balances, subtract all our depleting or income reducing balances. And we're going to carry across one single figure here, right? So the total column is going to have a total capital balance for the entire partnership. Yeah, that's the only change in your balance sheet. So let's recap. Some of the main headings in our partnership appropriation account, we need to look at stuff that needs to be added to our net income. So we're talking about interest on drawings is one, and probably the only one, right? And then things that is going to decrease our net profit. Interest on capital, salaries. Subsequent to that, we're going to look at share of profits, right? Interest on capital. What is interest on capital? Interest on capital is really the payments you are making to the partners for investing their capital in the partnership. And it should be in line with what they would have received if they invested it elsewhere, within reason. Why is it preferred for a fixed capital account to the fluctuating capital account? Because with the fixed capital account and current account, what that does is it helps us to identify situations where partners are withdrawing more than they need to out of the business, or more than they can afford to withdraw out of the business. And what goes on the current side of the current account? Well, share profits, interest on capital, right? Salaries. And when the balance brought down, balance carried down if you have an ideal situation. All right, let's look at some past paper questions now for practice. So I want to close this and we're going to open up a past paper question. Any questions on what we talked about so far? Right, so here we go. Let's open another tab. Right, so here's one. Chris and Dorcas are in partnership. Their capital and current accounts as at the 1st of January 2004 are as follows. So we have capital balances, 40,000 for Chris, 60,000 for Dorcas. We have current account balances, 5,000 for Chris, 3,000 for Dorcas. We have drawings on June 30th, right? Chris, and then on December 30th, Chris again. Then Dorcas drawings on April 30th, then 12,000 on August 31st, 12,000 on December 31st, right? The partnership agreement provides for the following. Profits and losses are shared between Chris and Dorcas in the same ratio as their capital. Chris is to be credited with a salary of 6,000 per annum. Interest on capital at 8% per annum is allowed. That's an important thing there. 8% per annum. That's for the whole year. Interest on drawings is charged at 10% per annum. This is really what I wanted to circle. 10% per annum. Why am I circling that and saying that? Because if we look at the question, they're telling you the date on which it is Chris borrowed the money. So if it's 10, the interest on drawing is 10% per annum, but he's borrowing halfway through the year, then we need to adjust accordingly. Right? Dorcas, 30th of April, 31st of August, we had to adjust accordingly. For the year, the profit is $95,950. Prepare the partnership profit and loss appropriation account for the year ending December 31st, 2004. Prepare the partnership capital and current accounts for the 31st of December 2004. And C, explain the meaning of a debit balance in the partner's current accounts. All right. So, just as we did last week, where I did the working, I want you guys to make an attempt at it first, but you're going to do this in some steps, just as I described last week. You need to start with your working. We read the question and we see some of the things we need to do. Well, one, we need to determine what the profit sharing ratio is. They say it's in the same ratio as their capital. So we have Chris and Dorcas. And that's a 4:6, or better yet, a 2:3 ratio. So the profit sharing ratio is 2:3. Does that make sense to you? Right? We need to make note that Chris has a salary, 6,000 per annum. Interest on capital, we're on the next slide. $8 per annum. Right? And you could work it out one time. You could do Chris, 8% by 40,000. You would work it out. Dorcas, 8% multiplied by 60,000. Right? So we have interest on capital. Interest on drawings is the next one. Right? So for Dorcas, he has 17,000 multiply by 10%, so that's 0.1. That's for the whole year. Multiply by 6 on 12, which is a half, right? 6 out of 12 months. He also has $17,000 by 10%, and he does it on the 30th of December. So that's like 2 days interest. So you could put 2 out of 365. And then 17,000, you're following that, right? Multiply by 10%, multiply by, on December 31st, 1 day of interest. So the figures you get for this one, and this one, you're adding it together, and that's going to give you your total drawings for, did I make something up there? Yes, I did, sorry. Chris and Chris is what I need to look for. So 6 by 12 and then 17,000 over 1 by 10%. Multiply by 2 days. The 30th is 1 day and the 31st is 1 day. 365 days in the annual year. And then for the other guy, that's Dorcas. Chris. Sorry, this was Chris. Turn on your mic at any point in time if you're feeling lost. Dorcas. Sorry, my name wrong. Dorcas has 12,000 by 10%. And April 30th. So there's May, June, July, August, September, October, November, December. 8 months. April, May, June, July, August, September, October, November, December. 8 months. So it'll be 8 by 12. Right? And then Dorcas again on the 12,000 by 1 multiplied by 10 over 100 because that's the percentage. And '31st of August, we said. So September, October, November, December, 4 months a year. And then the last one is just for the 12,000 multiplied by 10%. Multiplied by 1 out of 365 days. Yeah? Is everybody okay with the working for that? So remember, just like the example that I did last day, you wanna head up working, number you're working, do these things, and then you're actually going to do the actual format. Are you okay with this? Just indicate by using your mic and just let me know. Yes, no. Solana, you alright?
Yes, sir.
Very good. Dan, are you okay? Think you could tackle this question for me? Yeah? Okay. How about you, Solano? You okay? You try this one? Good. Recording again and just this was our working. And I just gonna head up your appropriation account. So we're starting with net profit. Net profit given in the question was 95,950. So I could take this off too. I use all of these things. So our net profit, we know with our format, we have to add interest on drawings. right? And we have for Chris, and we have for Dorcas. Right, for Chris, we have a total of 850 here, which we calculated before by taking the 17,000 of his drawings, right? 17,000 here. And this was on June 30th. So this is for half a year. It's for July, August, September, October, November, December, 6 months. So it's 10% multiplied by 6 over 12, and that's given us 850. And then he has another one, 17,000 on December 30th. So that's 17,000 by 10%, but then it will just be 1 day for the year, which is December 31st. So 1 out of 365. So Chris' total interest on drawings is 854.66. Dorcas, on the other hand, he has 12,000 on April 30th, right? That's 8 months out of the year: May, June, July, August, September, October, November, December. Right? So we're doing 10% of 12,000 by 8 on 12, that's 800. And then the other one is only 12,000 on the 31st of August. So that's September, October, November, December, 4 months. 12,000 by 10% by 4 on 12, that's 400. The other one is on the 31st of December, so that would apply to the following year. So we're not going to include that here. So Dorcas is 1,200 in total. Right? So what we're carrying across here is 2,054.66. Right? If you want, we could add this one time. So we have a nice total coming down. Five 950 plus 20.566. 98,466. Right? So that's the thing we need to add to our net profit. Next, we're looking at things we need to subtract, like interest on capital. Chris and Dorcas, you could use our third column here. And we did our calculation. Chris is 3,200, Dorcas is 4,800, and we found that by finding 8% of their capital, right? 8%, which is 0.08, multiplied by 40,000 for Chris and 60,000 for Dorcas. And that works out to be 3,200 and 4,800 respectively. So just gonna add some dollar signs here so you can distinguish the columns, right? So we have 3,200 for this guy. Right, and 4,800 for this guy. Our total here for now, because next we have salaries. And in our working, that's why it's important for us to do our working, 6,000 per annum. And that's for Chris gets 6,000 per annum. So that's a deduction of 14,000. Do that now. And that's it in terms of appropriation for our 84,000. Next part we're doing is the share profits. So Chris, Dorcas. The question said that they share in profits in the same ratio as their capital. We did our work in here for that. 40,000 to 60,000, which is 4 to 6. And if you reduce 4 and 6, that's 2 to 3. So Chris is getting 2/5 and Dorcas is getting 3/5. right? So 2/5 and 3/5. And this is of the 84,004. And this is of the 84,466. So we just punch that into the calculator. 2/5 multiplied by 84,004.66. That's going to give me 53,601. And then the bigger one is 3/5 by 80,000 or 84,000, sorry. $54,200. 80. 54,280. And you show it when you add it back up together. You balance the accounts. And that's what your profit and loss appropriation account would look like for the year ended 30th of December 2004. Yeah? Are you guys okay with that? Now, the second part, prepare the partnership capital and current accounts. So that's not too difficult for us to do. Let's look at that. You want a fixed capital account when you're doing a question like that. Well, usually they will provide you guys with some templates to work with, right? But it would have a column. You just do one capital account here, like so. And you put a column for Chris and a column for Dorcas. A column for Chris, a column for Dorcas. Right? Remember you want a fixed capital account. So you're looking at 40,000 and 60,000 is a balance carry on. So that's what you're gonna put here. You put your you'd have had an opening balance brought down Jan first balance carry down 40,000 and 60,000. And then on December 31st, you will just balance the account, you will say balance, not carry down, sorry, it should have been brought down. Carry down 40,000, 60,000. Right, and then the following year, it should have been 2004, 2004 here. Now we're going into 2005. January 1st, balance brought down 40,000 and 60,000. And that's it, the capital account ready. Don't have anything to it. The current account, you're doing the same thing already. In the sense that you need a column for Chris, one for Dorcas. One for Chris, one for Dorcas. They gave us balances to bring forward. So you always have to go back and you tick off the things that they use. You're gonna use these two now. 5,000, 3,000, and they're both on the credit side. So that tells me that on Jan 1st, which is 2004, balance brought forward or brought down was 5 and 3 respectively. Remember what I said earlier about the items and credits, so goes on to increase. Increases interest on capital. Yeah, no, 12 o'clock. And we have salaries. We also have share of profits. So interest on capital was what, 3,200 and 4,800. They do not here, 3,200 and 4,800. Salaries was just one guy, which was Chris, and he was 6,000. And share of profits was 33,601.86. And the other guy was 54,280. Right? On this debit side now, so that's my credit side completed. My debit side, I'm just gonna have the drawings and the interest on drawings. Right now, we're looking at all the drawings that happened within the reporting period, which is gonna cover everything. 17 and 17 for Chris is 34,000. Right, and for Dorcas, well, he withdrew everything within the period because we're doing this as at the 31st of December 2004. So 12 and 12 and 12, that's 36,000. We did our working for interest on drawings. Here we have 854.66. And this other one was 1,200. So obviously, our credit side is going to be larger for both of these. So what I'd like you guys to do is balance these up, this account for me for homework. Right, to look over what the balancing figure is. Right, look at the balancing figure. And then you're gonna put all these things here is at December 31st, okay? And then on January 1st, you'll put here for me your balance work down. I put your two figures. All right. Explain the meaning of a debit balance and the partner's current account. We covered that in our slide, so I'd like you to write that in for me. That's gonna be a homework. I'm gonna download this to send to you now. And well, the recording should become available, uploaded to YouTube on latest by Monday. I'll try to get done on the Sunday one. Sunday sometimes it's be a little challenge. All right, so any questions on what we looked at today?